So let me introduce President Joel Seligman. As most of you know or are aware, Joel has been president of the University of Rochester since July of 2005. Since being at the University of Rochester, he's had a very big impact. He's engaged the university in a strategic planning process that is very important and instrumental in charting our future. He's overseen many exciting events at the U of R. Just to name a few, the dedication of the Robert B. Gergen Hall of Biomedical Engineering, the new University Health Services Building, the James P. Wilmot Cancer Center, and many other campus developments. The prominence of U of R, and growing prominence, was recognized by Business Week in 2006 when they named the U of R as one of the nation's, quote, 25 new Ivies. Now, for this purposes of this panel, President Seligman is much more than our university president. He is, well, let me just mention his former positions first, and I'll talk about his expertise. He was dean of the Washington University School of Law before coming here, and he was a cum laude graduate of the Harvard Law School. Now, what brings him here is he's widely recognized as one of the world's leading experts on securities regulation. You might have seen him on the news and talking about it many times in this recent crisis period. He's written over 20 books and has co-authored or co-authored more than 40 articles on legal issues related to securities and corporations, including books that are considered to be seminal and important, base works in the field. So it is my pleasure to introduce Joel Seligman, who will take it from here.
Thank you so much for that very gracious introduction. It is a pleasure to join the Simon School and the Rochester Business Journal and this audience to discuss a truly important issue of public policy. I am going to try very hard to stick to my 10-minute limit, although I must say, having talked about this topic on many other occasions at much greater length, 10 minutes on a $9 trillion meltdown in an economy is the equivalent to a haiku. But let me see if I can frame it that gives a good basis for what will be, I suspect, a very engaging discussion. First, we almost melted down our financial order in the fall of 2008. And by way of a brief review of how serious things were, literally you saw, beginning with the housing bubble perceptibly beginning to burst in August 2007, a series of catastrophic events. Some of the highlights include the March 2008 failure of one of the 5 largest investment banks in the country, Bear Stearns. Literally, Bear Stearns was rescued by J.P. Morgan, but only because the Federal Reserve System came up with a $30 billion backup loan. On September 7th, 2008, Fannie Mae and Freddie Mac were placed in legal conservatorship. The United States government initially was going to provide up to $100 billion to each to keep them afloat. Fannie and Freddie at the time were responsible for approximately 50% of all residential mortgages in the United States, over $4 trillion. On a day that will live in infamy in financial circles, Lehman Brothers went bankrupt on September 14th, just 1 week later. The same evening, Bank of America moved to acquire Merrill Lynch for $50 billion. 2 days after that, on September 16th, AIG came to the brink. It was rescued initially by an $85 billion loan from the United States, which acquired 80% of its stock. By September 18th, the Secretary of the Treasury, Henry Paulson, believed, quote, the market is ready to collapse. This wasn't just his view. As we'll see within a fairly rapid-fire order, those deeply committed to the free market, including the President of the United States, including many in Congress, would come to share that view. On September 19th, the Treasury and the Fed took the lead in trying to raise $700 billion in a new appropriation from Congress to address troubled assets. Within days, the two largest investment banks in the country, Morgan Stanley and Goldman Sachs, had converted from being investment bank holding companies to bank holding companies so that they had the possibility of potential rescue by the Fed and the Treasury if Congress were to vote the money. On September 25th, a large commercial bank, Washington Mutual, failed. On September 26th, the fourth largest commercial bank, Wachovia, was on the brink of failure. On September 29th, the House voted down the initial $700 billion proposal, the Troubled Asset Rescue Program, or TARP. The Dow Jones that day had the largest one-day decline in its history, close to 800 points. A few days later, the Senate approved TARP by an overwhelming majority, and then 2 days after that, October 3rd, the House subsequently approved a modified version of TARP. The crisis accelerated. October 7th, Iceland, of all places, almost went bankrupt. October 8th, another $38 billion was needed to rescue AIG. October 10th, the G7, the seven most powerful economies in the world, met and, quote, put out an urgent and exceptional call for action, but didn't specify what it meant. The Dow Jones lost 8% that day. October 13th, $25 billion was initially lent to the American Big Three automakers. October 13th, the Treasury suddenly announced a totally new approach to trying to rescue investment in commercial banks by making direct investments rather than through the concept of buying troubled assets, and within days had invested $125 billion, starting with $25 billion for Citicorp, Wells Fargo, and J.P. Morgan. Within a couple of days after that, AIG's losses had further expanded so that within the period by early November, it received yet another $40 billion of support. On November 12th, the FDIC guaranteed up to $139 billion of GE capital. On November 19th, the largest commercial bank, Citicorp, was near meltdown. It ultimately received a loss-sharing plan orchestrated by the federal government to guarantee up to $306 billion of identified assets. December, Bernie Madoff confessed to having stolen at least $50 billion in the largest Ponzi scheme in our history. Now, given that I only have 10 minutes, I have to cut short this resume, but it doesn't end in December. It continues right up at least till March 9th, 2009, where the Dow Jones reached a point of having declined 54% from its high of November 9th, 2007 of 14,165 to a close of 6,547. Of greater consequence conceivably was that the debt markets were effectively closed for months. Unemployment rose to over 10%. There was as great a feeling of uncertainty and fear among not only those whose 401ks had been driven down by 40 or 50%, but those leading the largest private and governmental institutions in this country. What happened? I would like to suggest that there are many causes one can address in this extraordinary debacle, but four, at least for me, stand out as of the greatest significance. First, we had a crisis that began in the housing market, an age in which typically banks would lend money and hold mortgages and felt an incentive to care about record-keeping and collateral, was replaced by an age in which a substantial percentage of mortgages, perhaps as much as 50%, were now written by mortgage brokers who wanted to securitize them or get them off their hands as quickly as possible. This was the age of the ninja loan, that is, loans made to individuals with no income, jobs, or assets. It was an age of as irresponsible practices in the mortgage industry as we'd ever seen. Who would buy securities, mortgage-backed securities, under such circumstances? You had a series of significant investment banks who bought and resold them then fairly rapidly at a time when there were extraordinarily glowing reports, typically written about these securities by credit rating agencies. AAA ratings were standard for worlds of subprime mortgages and what in retrospect was extraordinarily greater risk. Second, you had a fundamental misalignment between federal and state regulation and underlying industry. Our regulatory system in finance essentially reached its current phase in the New Deal period. At that time, the economy was atomized. If you were a securities investment bank, you were only a securities investment bank. You weren't in commercial banking. And so a system of regulation that separately dealt with securities, commercial banking, insurance made some sense and was sustainable and reasonably effective for many decades. That world is long gone. We increasingly face a world in which we have financial supermarkets which not only are in securities, commercial banking, and insurance, but also swap instruments, commodities, and are not just located in the United States, but in many instances are global institutions as well. Regulation simply did not keep up. It was not properly structured for a brave new world. Third, there was a colossal failure of leadership at the federal level. Many instances of this, but if I ever have the chance to write another history of financial regulation along the lines of a study I once did of the SEC, one of the most interesting questions I want to explore is to try to understand why there wasn't a much more fervent reaction to the obvious decline of Fannie Mae and Freddie Mac or to the failure of Bear Stearns. They were treated as exceptional events. There was a reluctance to go to Congress. There was a reluctance to wave the red flag and say, this was a crisis, this is an emergency, we need a new order of things. I recently read Hank Paulson's book, On the Brink, and I read it from cover to cover, and I have no greater illumination having read that book than before. And it's not to be catty or cute, it's just simply there's a good deal more to the story than is yet known. Fourth, you had a systematic breakdown in enforcement of existing laws and fraud deterrence. The SEC, an agency I have studied and written about and in some respects defended for decades, was particularly culpable here. Reports have been produced on its role in the Bear Stearns oversight or Bernie Madoff case. It was an agency where the tone at the top was not pro-enforcement. There was a discouragement in some case of being effective in the enforcement realm. It was too siloed. Tough issues were not escalated, understaffed, and the staff was often in awe of legendary figures like Bernie Madoff and so on. Now, what are the key legislative issues or public policy issues that are being considered by Congress, and I think will frame some of our conversation? In December, the House of Representatives passed H.R. 4173. I believe it's something like the Wall Street and Consumer Protection Act. It is 2,200 pages long. I actually read it quickly. I will give Congress credit unexpectedly tonight for using really large font. It's easier to read than a lot of documents I have to read. But having said that, we know what issues the House has so far focused on. There is a moving process going on with the Senate. I'm going to tee up 6 issues that are clearly on the legislative agenda. No one should have any illusions. There are many more than this, but these strike me at least as 6 very important issues. First, systemic risk. This is the concept that consistently the Treasury, the Fed, the SEC was blindsided by events, and consistently its ability to respond to events was too limited. Proposals have been made, including one I offered in testimony to the House, to create the Federal Reserve Bank, or formally recognize the Federal Reserve Bank as the quarterback, in effect, in crises like this, and to authorize it to have greater powers to try to avoid and then respond to this type of situation. I will say the Federal Reserve Bank is not universally loved in this country. Indeed, it's been kind of a whipping boy. And so there's tremendous debate in Congress as to what powers people are willing to accord the Fed, and whether the Fed itself will be supervised by what is literally called a Supervisory Council, which would include representatives from the Treasury, the SEC, the Federal Deposit Insurance Corporation, and so forth. The emphasis in the House bill was on trying to prevent a crisis of this sort through reporting and rulemaking initiatives. My concern is also with having someone in place when a crisis occurs, and I don't see how a council can be as effective then. Number two, wind-down authority, as it's popularly called. The notion that rather than being boxed into a situation where you have 2 days or 4 days to address a Lehman Brothers or Bear Stearns type crisis, the FDIC, under the House and presumably the Senate version, would have the ability to pursue an orderly bankruptcy over time. Big question here is market confidence. When you face the situation after Lehman Brothers failed, would you allow AIG to fail? There was tremendous hesitation, and the hesitation was very simple. It has what are called counterparties on a number of different instruments that it sells. If AIG failed, if money was frozen in an AIG bankruptcy, this can then have a widening circle of implications, not only Iceland, but investors in this country and throughout the world. Is wind-down authority going to be sufficient? Can it be used with all firms, or are there some firms too big to fail, as the saying goes? Number three, we have a half-regulated, half-unregulated system of finance. I've referred to banks, insurance, and securities firms, but over-the-counter derivatives, which were very pivotal as techniques for reducing the risk of holding mortgage-backed securities, hedge funds, to name the two most prominent examples, essentially were unregulated. This makes very little sense. Among other things, it means that whoever is responsible for addressing systemic risk doesn't have effective information on a timely basis necessarily. It means, in effect, that there can be greater risk taken by either those who hold or trade OTC derivatives or in the hedge fund industry that might be wise for the economy. Presumably, in both the House and Senate version, OTC derivatives and hedge funds will be brought under the umbrella and subject to some form of regulation, but the truth is in the details here. What exceptions or carve-outs will there be? How far-reaching will the regulation go? And at the moment, the answers are somewhat discouraging. Number four, credit rating agencies. Credit rating agencies were perhaps as unpopular a group in testimony before Congress as any I have ever seen. They, in effect, were receiving huge fees in instances from those who issued securities, and the securities, in retrospect, were overpraised or overrated by the credit rating agencies. No question that they will be subject to more significant forms of regulation, but at the same time, there is a fundamental challenge in regulating credit rating agencies. If you want to eliminate the conflict of having someone whose own securities are being rated, you could basically prohibit that and say the credit rating agencies have to be paid by the buyers of securities. If you do that, however, probably there would be 10 or 20% as many credit ratings as you have now. Are we better off ultimately with a flawed and conflicted system of credit ratings that is at least different than management itself appraising itself, or are we better off going to the alternative, which would be a purer, if you will, form of credit rating agency approach? Congress is clearly tipping towards the conflicted but better regulated approach. Number 5, you may have seen stories today, and there have been frequently, about an effort by the Obama administration, supported in the House and to some degree in the Senate, to create a new consumer financial products agency. This would address the fact that subprime mortgages, complicated and exotic mortgage products, in particular credit cards, are often inexplicable to retail investors, which is how investment banks and commercial banks refer to people like you and me. The Consumer Financial Credit Products Agency would be an approach to simplify, to focus on the investor or consumer first. It's not going to happen as a separate agency. That seems reasonably clear from statements made by Senator Dodd and his staff relatively recently. Question is, will it become a division of the Federal Reserve Bank? And if it does, how will the Fed effectively harmonize a consumer thrust with its basic concern, which is the safety and solvency of depository institutions or the overall macro performance of the economy? Finally, I have argued from time to time that one of the reasons that our regulatory agencies are so inconsistent in performance is the way they're funded. The SEC receives or is responsible for typically 100 to 200% more in fees received by the federal government than Congress is willing to appropriate it. It is in a kind of regulatory vise, if you will. After a crisis, it is adequately funded for a while, but when the market is doing well, when we have reached those magical moments of the new economy, when we have much greater confidence than we currently do in investment bankers, support for the SEC dissipates, and you get into a mismatch where those that the Commission is supposed to regulate are growing at very fast rates, and the SEC is at most holding still or shrinking. I've proposed that the SEC, like the Federal Reserve Bank and the FDIC, be self-funded, which is to say that it would identify a budget and work with the industry to collect fees, as it now specifies fee areas. This is a proposal which I have proposed from time to time. It may have a chance to be adopted now. Senator Schumer is leading the charge on this, but it apparently is a divisive one. Many in Congress do not want to give up the lever of budgetary controls with respect to the SEC, although they can't explain why they can do it with some financial regulators but not with others. Well, I hope I haven't gone too much over 10 minutes. I am very eager to hear the other speakers, and you have to appreciate the humility with which I approach this topic. I am a mere lawyer. To be on a panel with financial economists of the quality of those you're about to hear is absolutely a great pleasure, but it makes me feel a little bit like the title of an Anais Nin novel I once saw but actually didn't read. I feel a little bit like a spy in the house of love. So we'll see how well I hold up to these tough customers. Take care.
Well, it is with great pleasure I introduce our next speaker, Professor Clifford W. Smith, who probably doesn't require a lot of introduction to many of you. Cliff is the Louise and Henry Epstein Professor of Business Administration at the Simon School, and to many of us, Cliff is the consummate role model of what it means to be a good professor. He has a long and very distinguished record in publishing really path-breaking research on a variety of financial topics. He's the co-author of 18 books and over 100 articles in leading finance journals. He served on the editorial board and served as an editor of our leading finance journal. He's been active in professional associations. In terms of his teaching, he has won over 30 Superior Teaching Awards in our MBA and our EMBA, our Executive MBA programs. His walls are being filled up now with all of his, plaques and stuff, and I have volunteered that as he continues to win awards in the future, he can use some of the space in my office. So I'm sure he'll have to take me up on that. Cliff's also served on on various corporate boards, as well as served as a consultant for leading corporations and financial institutions. So, Cliff.
Good evening. I don't do so well when I get tied down behind some platform like that, so excuse me if I wander around. It's awfully good to see so many of you here. Joel did a wonderful job of laying out some of the history, some of the challenges that we face, and some of the possibilities about the regulation. I'd like to take another step along the way of talking about an appropriate regulatory response, and in some dimensions I probably want to throw a little cold water on getting too aggressive with respect to where we go in this regulatory process. One of my favorite economists is a fellow that used to be at the economics department at UCLA. His name's Harold Dempsitz, and Harold wrote an article that I'd like to paraphrase just slightly. He talked about what he referred to as the nirvana fallacy. And one of the things that I worry is a potential problem when we talk about regulation in this industry is running afoul of the problem that Harold labeled the nirvana fallacy. He said that you ask an economist how you might solve a problem, and all too frequently what a well-trained economist will do is to say, well, let me imagine a perfect Congress adopting a perfect regulation that is then enforced by a perfect set of regulators, and let's see if in that nirvana environment, if I could talk myself into the proposition that that outcome would be better than what in fact we currently have. The fact of the matter is, Congress ain't perfect. The regulatory outcome that we're likely to get out of Congress is rarely perfect. And when it's turned over to regulators to implement, there are a whole array of imperfections, some of which Joel indirectly alluded to a little earlier. Politics rears its ugly head in discussions like this frequently. If you think back to the recent presidential campaign, candidate Obama talked frequently about his proposal for a stimulus plan. And on the campaign trail, what he kept talking about were infrastructure projects and shovel-ready infrastructure projects. That was going to be the cornerstone of the stimulus package that he wanted to sign and implement in the early days of his presidency. We got a stimulus package, and it was passed. But if you look at the details of what in fact was passed, it was largely recycled pork, and less than half of what was voted on has even today begun to be spent. So what was promised in the campaign and what was delivered in the administration is not always going to be exactly the same thing. And I think that it's important for us to have this reality check and ask ourselves not just what in some idealized setting might be possible, but what, given the politics that are ultimately going to be rearing its ugly head in Washington, what in fact is likely to be delivered and implemented and we have to live with. When you look back at a lot of regulation, and to be honest with you, I think what we're going to see in some of the regulation here is an attempt to codify best practice. To a first approximation, that explains a fair amount of the regulation that occurred back in the 30s when the SEC was originally set up. Industry experts were brought in. Best practice was put down as a regulatory protocol. Now, this does two good things. One is it generates a lot of code in a short period of time. The second thing that it does is, by and large, it works. But there's an ugly, dark side to that approach to regulation that I'd like to caution you about. One is, there's competition in the marketplace that helps discipline people that would misbehave in the marketplace. Now, a lot of the most effective competition doesn't come from one big established financial institution competing with another big financial institution. Some really important competition comes from smaller, more entrepreneurial firms trying to enter a market competing with larger, more established firms. Codifying best practice puts the brakes on smaller, more entrepreneurial firms trying to enter. And that's a cost. The second thing that this does is by specifying process, look, there's not over in Rushree's library some answer book for this problem. This is not like some well-understood engineering problem. You want to build a bridge from one side of the Genesee to the other. What's so much of what we understand about markets and contracts and the structure of markets and the regulation of markets is an accumulation of a bunch of trial and error. When you pass regulation that codifies best practice, you codify procedures, which means that experiments that especially some of these smaller, more entrepreneurial firms might have engaged in, all of a sudden now are regulatorily precluded. And things that we would have learned, innovations that would have occurred in this ultimately quite Darwinian process, stop. We ossify competition, practice in the industry, and the longer that stays in place, the bigger those problems accumulate to be. So I worry about too quickly bringing in a lot of new regulations for at least two important reasons. One is it reduces competition, and second, it reduces innovation in the marketplace, something that I would argue is a critical component of why the U.S. plays such a dominant, leading role in not just this country's, but the entire world's capital markets. Thank you.
Our next speaker is Professor Tony Whited. Tony is the Michael and Diane Jones Professor of Business Administration at Simon. She's had that position since last year, February 2009. We were very fortunate to be able to hire Tony away from the University of Wisconsin, where she served as a chaired professor for a number of years. Tony is widely considered to be among the top academic researchers in finance. Particularly important work that she's done has been on the effects of financial markets on corporate investment decisions, which I think is a very timely topic for today. She's been the two-time winner of the prestigious Brattle Prize, which is awarded to top articles in the Journal of Finance, published in the Journal of Finance, which is one of our leading finance journals, and she served on the editorial boards of a number of top finance journals. Particularly apropos for today, Tony received her PhD in economics from Princeton University, and her dissertation supervisor was Ben Bernanke, who I'm sure you've heard of and know is the current chairman of the Federal Reserve Board. So, Tony?
So I wanted to spend my 5 minutes talking about the mortgage market and talking about policies to relieve foreclosures and talking about policies that might prevent another mortgage meltdown. So I guess the first thing I'll talk about is policies to relieve foreclosures. Foreclosures are actually going up right now. They're continuing to increase. And so that's going on. However, I think that the popular idea that foreclosures are caused by unscrupulous mortgage brokers who gave out all these subprime loans and then these poor people foreclosed is actually wrong. If you look at the statistics, only about a third of the mortgages that are underwater right now are subprime. The rest are either FHA or VA, or they're just prime mortgages. So what's going on? There's a couple things that are going on. Why do people foreclose? Let's see, they lose their jobs. The other reason why they foreclose is when they lose their jobs, they can't sell their house because they'd have to take a check to the bank. So this is what's primarily causing the foreclosure rate, which is continuing to go up and up and up. Now, should we do anything about this? And I think the answer is yes, because if I foreclose on my house, that affects you. And basic economic policy says that when that happens, we should do something about it. If I just foreclosed on my house and I got hurt all by myself, who cares? But if I foreclose on my house and it has wider effects, then as a public policy issue, we should do something about it. It also costs the taxpayers money. About half of all mortgage are either insured by the FHA, the VA, or Freddie or Fannie. And so if these mortgages go underwater and there's a foreclosure, that costs taxpayers, I don't know, about 36 cents on the dollar. And so that's very expensive. So should we do nothing? No. So what should we do? The current plan that's out there is to help banks renegotiate contracts. And I think that that is basically bad economics. So why is it bad economics? It messes up contracts. So let's say you're a bank, you have a mortgage, and then all of a sudden the government says we'll give you a little bit of money, but you have to change the way the contract works. Well, that gives banks an incentive not to do mortgages again, and that's not what we want. That's really not what we want. So, and the other thing that's wrong with this is that if you're unemployed, you do not qualify for a mortgage readjustment. So it's targeting the people who don't need the help in the first place. A couple of folks at the Federal Reserve Bank of Boston have come up with what I think is a much better idea, which is housing vouchers. So let's say you get unemployed, and as part of your unemployment benefits, you also get a housing voucher that will make you spend a big chunk of your income on housing, because these will only be good for housing. So it's a gift, but it's not a big gift. And then that would prevent the foreclosures. It would keep people in their houses, it would prevent the foreclosures, and it would be substantially less expensive than either doing nothing or what the administration is doing now by messing up bank contracts. So that's what I think would be a better way to do this. Actually, my former state of residence, Wisconsin, is starting to do this. And they think that that will be a much more efficient way of fixing a problem that needs to be fixed. So that's the first thing I wanted to talk about. The second thing I wanted to talk about very, very briefly is how we got into this problem in the first place. So let's say you're a mortgage broker and you want to underwrite a subprime mortgage. Well, then you're going to sell it. So what are your incentives to do that? You get a good price. Okay, so that's fine. And why are you getting a good price? Because somewhere down the road, this mortgage gets glued together with a whole bunch of other mortgage and resold. And the reason why they're getting a good price is because the rating agencies were giving these things too high of prices. And President Seligman talked about the problems with changing this system. And the reason why they were getting too high prices is because the people who were selling the mortgage-backed securities were paying for the ratings. And it's pretty clear the conflict of interest there, right? So we have to also do something about that. On that front, I'm not quite clear what I think would be the best idea. Having the other side pay for it would create, as he said, many smaller rating agencies that might not be efficient. As far as I can tell right now, though, I think that might be the best way. But we have to get rid of this incentive problem. What we shouldn't do is ban subprime mortgages. They actually help some people. I know people who have been able to buy houses because they got a subprime mortgage and they're still in them. So we shouldn't ban the subprime mortgages, we should just make the prices right. Once we make the prices right, then we'll get a better, well, we won't get too many of them, but we won't get rid of them because they actually do help some people. And that's all I wanted to say. Thanks.
The final speaker is Daniel Burnside. Dan is Vice President and Director of Quantitative Research at Federated Clover Investment Advisors in Rochester. So we have somebody who is experienced from the trenches here, having had extensive experience working with both individual and institutional clients on a variety of investment and risk management issues. Dan also teaches courses for us up at Simon that are one very popular and well subscribed and two very useful and important. He's a chartered financial analyst and a certified financial planner. He holds a PhD in engineering and mathematics from Cornell University, and we're proud to say he has an MBA from the Simon School. So, Dan?
Okay, so I heard that this was a forum on financial regulation, and so I guess implicitly what that's really about is reform. That's a word people like to use. That's a euphemism for changing something, and some people like that, and some people don't. You know, here's my overall take on the whole issue of financial reform right now is that, you know, the horse has left the barn, okay? You know, the damage is done, and it was a lot of damage. And we have to make sure that we don't have something like that again, but I don't think something like that's going to happen for a while. I don't know when it's going to happen, but I'm thinking it's a 10 or 20-year kind of thing. It's not going to happen before the November midterm congressional elections, okay? We've already unwound a lot of the precipitating factors of this. I think this is going way too fast. You know, reform proposals, whether people say it or not, are hypotheses of causes of some kind of problem, right? But they often are not stated that way. But somewhere in the proposal is someone's idea about how something happened and how it could be prevented. And it's hard work to figure those things out. I don't know all the answers about the things we're going to talk about tonight, but I do know that scholars are going to be studying the events of the past couple of years for decades. It's going to be a serious topic of academic study, just as the Great Depression is still to this day a topic of serious study. And yet, you know, as I said, we've got these elections coming up, and I'm afraid that these politicians want to get out there in time to tell everybody that they did something about this, you know. Now, President Seligman, he referred to a 2,000-page House bill, and I was looking at the Senate finance bill, or one version of it, and the Senate, I guess, is a little more efficient, maybe because they have fewer members. It's only 1,100 pages long, but it's double-spaced, so I guess, well, you know, it's not as long as it sounds. I mean, I wanted to read that before I came to talk to you tonight, but I think it's impossible. So let me give you a sense of why I think the cart is being put in front of the horse here. While we've got the senators breathlessly, you know, twittering to us about, you know, their moment-by-moment negotiations, in parallel, we have this other group of people that the President of the United States has appointed called the Financial Crisis Inquiry Commission. And so as not to mischaracterize them, I'm going to quote from their mandate. It says, their purpose is to, quote, examine the causes, domestic and global, of the current financial and economic crisis in the United States. I mean, that sounds like a pretty important thing, especially if we're going to, you know, prevent such a thing from happening again. There are 10 members of this commission. They were appointed in July of '09, and they're going to produce a report. And the deadline for the report is December 15th, 2010. I mean, we're going to solve this problem before anybody even tries to take a stab at explaining it, you know, what happened. Just as a little jab, I'll throw in that I looked at the bios of all these folks, and I couldn't find any economists. The chairman is a history major. I like history. That's a great subject of study. I just don't know why we don't have any economists on that board. I mean, it says right there in their mandate, economic crisis. I mean, seems like an economist should be involved, but apparently not. So the senators and the representatives are going to solve this problem, and then a few months later, these other people who are not economists are going to explain to us what happened. And I'm reading these preliminary, unpublished academic papers where people are just trying to scratch out some understanding of some of these things that have happened. It's going to take a long time to get through. That's why everything I'm saying is so tentative. Okay, so, all right, I've challenged myself here to give you a cause for these problems, and I will. You know, I'll just state it as an unproven proposition that, you know, any mess that's sufficiently gigantic in size could not possibly have one cause. I mean, there's got to be a million things going wrong that just kind of all happen together. And, you know, this thing has a lot of that, okay? Perfect storm, that's a nice cliche I keep reading, you know. There are a lot of aggravating factors to this, and I'm going to just briefly mention them just so you know that I'm paying attention. But in my assessment, my opinion, the main cause of this problem that we had is that we have a gigantic banking system in the United States that's evolved over a few decades now that some people call the shadow banking system. And we had a run on that, okay? I think that's what happened. And I'll give you some more details in a few cards. So let me talk about some of these aggravating issues, because some of them are interesting. You know, they say you can't tell who's swimming naked until the tide comes in. And, you know, the tide came in, and there were a lot of people out there naked. And, you know, they were naked before, but nobody noticed. Some of these issues have been mentioned by some of the prior speakers tonight. You know, the whole way we originated these subprime mortgages, these mortgages that were given to people who, by traditional historical standards, you know, wouldn't have been able to get a mortgage. The whole way that was done, there are a lot of problems with that. Okay, not just economic problems, but you know, there are people that are going to have criminal problems in there. There was a lot of mischaracterization, you know, bait and switch, you name it. There was a lot of bad behavior. Did that cause the financial crisis? I don't think so, but it didn't help, you know. The securitization of mortgages, I mean, here's a financial innovation that really kind of changed everything. I mean, it used to be that when the bank or the savings and loan, the credit union gave somebody a mortgage, that was an asset of theirs, and they kept that on their balance sheet. And well, because they did that, they were pretty diligent about making sure that that person had a job, and they made sure that they put down enough money on the house so that if the house value went down, they wouldn't have an incentive to walk away from it. They'd continue paying their mortgage, you know. That's the way it used to work. But a lot of mortgages now, and most of the subprime mortgages during the period we're talking about, they were bundled up into these big buckets, and then they were sliced into pieces, and then they were kind of sold everywhere, right? There's nothing nefarious about that in itself. Everybody got to be diversified, you know, that's supposed to be a good thing. The problem is that the companies that originated the mortgages didn't, as we say, they didn't have any skin in the game. And once they got the signature on the application and they threw the loan over to somebody else, they got a fee and they were done. And that's why we were giving mortgages to people who, you know, didn't have a job, didn't have any income, didn't put down any money. I think we had a liquidity glut after the last recession. If I read the Federal Reserve Chairman correctly, I think that he thinks that too, although I haven't heard him say that explicitly. We've talked about the credit rating agencies. That thing's a mess. There's so many conflicts of interest in there, I don't know how anybody expected that to work correctly. The SEC, okay, well, I have people here tonight who know more about that than I do, so I'll just say 2 words about that. Bernie Madoff, okay? You know, if you can't stop that, I mean, you know, what are you doing? I think that's the opinion of the guy on the street, and I'm one of those guys. Fannie Mae and Freddie Mac, these government-sponsored entities, I don't know why they exist. They seem to be a strange way for the government to implement some kind of housing policy without having the congressman, you know, discuss it and put it in the budget. And then somehow we allow those organizations that are backed by the U.S. government to turn around and give campaign donations to senators and congressmen, many of whom are sitting on the Senate Finance Committee who are debating this bill right at this moment. I just don't understand that. We had mathematical models of mortgages that weren't right. We should have a clearinghouse, a central place where derivatives, certain derivatives, get traded, just like we do for futures and agricultural products. Okay, and we had problems because we didn't do that. We had an explosion of so-called off-balance sheet activities, which are not inherently bad, but I think they distorted the accounting and they made it look like companies weren't doing things that they were, and they were more levered than we thought they were, and it got them around certain regulations. Okay, Cliff was talking about how you have a regulation and then people start to behave differently because of it. Well, you know, there's a good example of that. you know, I'll even blame the internet. I mean, the Washington Mutual run was mostly on the internet. I mean, you know, people didn't run down to the bank to get the money. They heard the news, they went online and they took their money out. I mean, it didn't take very long to get the money out. Did the internet cause the problem? I don't think so. But okay, so I was talking about banks, shadow banks. Okay, what's a bank? All right. Okay, this is my definition of a bank. A bank is an entity that lends long and borrows short. Right? They invest in things, or they lay out the money for a long time. It's hard to value those things. It's hard to sell them. It's illiquid. But they finance it with short money. People give them the money, and maybe they might want it back soon. Okay? That's a very important function in society because most of us want to do the opposite. Right? Most of us want to own a house, borrow the money for a long time, and then we have a little money, we put it in the bank, but we might want to go get it at any time. Well, somebody's got to be on the other side of that, and I call those banks. Now, there's an old expression that banks are special, you know, and they are. Not just because they provide this valuable service, but there's a special risk that they have, which is that they're at risk of having runs. And I won't go into a colorful explanation of that because I assume that you all watched It's a Wonderful Life with Jimmy Stewart, where he explained at Bailey Savings and Loan how it worked. Right? He explained to everybody that there wasn't any money there. The money was in their houses and businesses and so on. And yeah, that's right. So, you know, this is a great system of providing liquidity, but everybody can't use it at the same time. That's the key. Some of us, some of the time, can go and get some of our money and everything's fine. But we all can't go at the same time to get our money because it's not there. And, to make it even worse, if we think that the other people are going to get their money, then we want to get there first. Okay, that's why it's called a run, because you know you run there. All right. Now, how do we handle this problem with banks? Well, you know, we used to have runs in the 19th century, and we had runs for the first few decades of the 20th century, and then we had some new legislation, and we created the FDIC in 1933, and we said, okay, we're going to prevent the runs by giving people confidence that the money will be there if they go to get it. And then they won't have to go get it today because they're worried they won't be there tomorrow because they know it's going to be there tomorrow. And then they won't go get it today, right? And that's worked for 80 years. But there's an economic principle that's very important that goes along with that we call moral hazard. And that is, you know, when you insure somebody, it changes their behavior. And when you tell a bank or anybody that you're going to back them up if something bad happens, you know, they're not as prudent. And from your perspective, they might behave recklessly, but not from their perspective because, you know, it becomes a heads they win, tails you lose kind of thing. So, you know, we have a huge economy of institutions that do what I just described, but they're not banks. You know, Lehman Brothers, Bear Stearns, Goldman Sachs, Merrill Lynch, Morgan Stanley, those are just the big ones. GE Capital, all these little loan originators, some hedge funds. eBay, I mean, eBay does some of the stuff I was talking about. Just to give you just one number about how big this stuff is, those five that I mentioned at first, at their peak, their liabilities, hard money that they owed was about $9 trillion. That's about half of our GNP for a year, so that's a lot concentrated in those companies. So what happened? Well, we had an economic slowdown. I mean, the business cycle has not been repealed, as they say. It happens. But then we had a run on these, collectively on these organizations. And why did it cause such a serious problem? It caused a serious problem because we did half of the thing that we did with the banks, which was the part about backing them up. We provided insurance for them. We bailed them out. We gave them a huge amount of money. It's going to take a long time even to figure out exactly how much money it was, but it was a lot. But we didn't get anything, we didn't do the other part of it. We didn't monitor what they do to make sure they didn't do anything reckless. And in fact, they did a lot of things that look reckless. But it was very rational from their point of view, because if it worked out, they were going to make a ton of money. And they made a ton of money for a long time. Why did we bail them out? Because they were too big to fail. It would have caused too much damage. I'm increasingly seeing economists use other phrases for that. I'm hearing people say too systematic to fail, too connected, as President Seligman said, too connected systemically to the economy, too interconnected to fail. My favorite expression that I've read is too connected to Goldman Sachs to fail. And I don't think the person who said that was joking around. Now, what are we going to do about this? The system's still there. Some people have proposed that the way to deal with this moral hazard problem is, we're not going to bail them out. That's a cutesy thing that academics say that don't have to make any policy decisions, but, that's not going to happen. We've been watching governments bail out organizations for centuries, and they're going to keep doing it. We have to prevent it from happening, okay? These organizations are getting all the advantages of being banks without the cost. Okay, so I don't have the magic, recipe for this, but I have two proposals or two ideas that I think should be part of what's going on. Besides, that everybody should just slow down and take a breath and not try to pass something by November. The first is that I agree with President Seligman that we need to extend regulation in some way, shape, or form to these things which are not banks, because they walk like banks and talk like banks, and we back them up like banks. Okay, I don't know how to do that. Okay, should the Federal Reserve do that? I don't know. The Treasury Department? I don't know. Should it be some independent new something or other? I don't know. It shouldn't be some group that's begging Congress for money every couple of years. That's not going to work, because as soon as they do something that one of the parties doesn't like, they'll make sure they don't get any money. Okay, so it won't work. We have to have some way to, like some built-in kind of governor on this thing. People have been talking about how to wind down these organizations when they screw up, and part of the Senate bill is, these companies have to write their own funeral plan. I think that's too far after a problem. I think it has to be much, much sooner. I like the idea that we set up a capital structure for these companies that has an automatic aspect to it. I particularly like this idea that some of the debt of these companies could be automatically turned into equity if a certain triggering event occurs. Okay, not only will that give them equity that we as the taxpayers don't have to give them, but it'll also mean all their counterparties now think it's safe to do business with them. And the creditors, the people who loan them the money, they don't want that to happen. They don't want their debt to go away, so they're going to now monitor. Everybody's gotten a free ride. I like that. I don't know if that's going to work. There is an aspect of that in the Senate bill, but I don't know how laws get made, so I don't know what's going to happen. So that's all I got.
Okay, well, time permitting now, we'll answer, or try to answer, the panel will, some of the questions you raised. I will say in advance that if your question that you ask was not answered and you're interested in talking about it, some of the panelists will be here after the session ends. So I've grouped some of the questions together because they're on similar themes. The first question I might ask the panel has to do with international versus domestic regulation change. Many countries around the world are grappling with similar issues. Some people argue it's important to coordinate these efforts. But Joe Stiglitz, Nobel Prize winner in economics, was recently quoted as saying that he thinks it's appropriate for the U.S. to fix its own regulations first, regardless of what other countries do, while others say, well, wait, if the U.S. does that, that's going to make U.S. federal or financial institutions less competitive and maybe pull of financial activity away from the U.S. Do you have any comments on that?
I guess I agree more with Joe than I disagree with him. I think that if regulation is well crafted, the benefits of regulation are going to exceed the costs. And what should happen is the investing public, whether it's domestic or international investors, should wind up with more confidence in investing in U.S. capital markets if we do the regulation right. If we screw it up and regulation winds up being effectively a tax on the markets and the companies whose shares are traded in those markets, then this other concern is well placed, well founded, that what you're going to do is make the U.S. capital markets less efficient and less effective in competing with markets in London or Frankfurt or Tokyo, and we wind up undercutting the proverbial goose that has in so many dimensions laid the golden capital market egg.
I would suggest the answer to this question isn't a categorical one way or the other. There's some aspects of our regulatory framework which already are to some degree coordinated internationally. You see this in banking, you see this in efforts at the presidential or Secretary of Treasury level through G7, G20. Stiglitz, I think, though I don't know the precise origin of the quote, was focusing on the tension between United States generally accepted accounting principles and international standards, or United States disclosure concepts and international. And there is a real differential there. The anxiety some have is if the United States was to convert to international standards, they would be watering down our current regulatory norms, which in these respects may have been pretty effective. The question you have often with designing regulation above the cost and benefits that Cliff recognized is, why are you regulating? And in this country, we've had tremendous focus in our investment and consumer products on not just safety and solvency issues, which I think are absolutely fundamentally important, but also on what we call retail investors or sometimes, Uncle Harriet and Uncle Bill. And we have in our country today a much larger number of people who directly or indirectly buy stocks than any other country in the world, in part because we have a different form of regulation.
Another question. The so-called Volcker Plan that is endorsed by the Obama administration would prohibit banks from engaging in proprietary trading. Is this a good idea?
The Glass-Steagall Act was adopted in, I believe, June of 1933, and it separated investment bank from commercial bank through 1999. And it slowly evaporated as we created financial supermarkets and then fell with a thump with Congress. The point that Volcker and the President made in commending this particular approach was not to go back to a complete separation, but that if the federal government was going to provide money to investment banks and other institutions, that in effect was giving them a certain form of guarantee, they couldn't at the same time be taking what was viewed by Volcker as extraordinary risk through proprietary trading. I think there's something to this. My concern, though, is in an international economy, is it workable? That is to say, if you created a domestic Volcker plan, what would prevent a United States investment bank from setting up a subsidiary in another country where you didn't have the same kind of limit? And because of that, while I understand where he's coming from, I may be a little less enthusiastic about this one.
Another question. Bonus and incentive compensation in banks seems out of control. Should the government do something about this?
This is one of those things where I fundamentally believe this is the worst kind of process regulation. The government doesn't have a comparative advantage in micromanaging compensation policy decisions within banks or, I'll go further, any other private institution. And you know, when the pay czar started coming out with pronouncements, TARP strings started restricting compensation packages, people that I know said that some of the most talented, best respected analysts in financial institutions' phones started ringing off the wall. And by and large, the people on the other end of the line were headhunters that were working for Japanese banks, Swiss banks, British banks, saying, you know, how would you like to work for another financial institution that will pay you a world-class salary that doesn't have any of this idiocy that the U.S. is imposing? And you know, usually when you talk about international brain drain problems, the rest of the world shakes their fist at the U.S. because we have been overwhelmingly the beneficiary of the flight to a more open, competitive environment, a place where bright, talented, aggressive people could make of themselves whatever their potential permitted. This is starting a reverse brain drain, and the longer it goes and the more detailed it gets, the more pernicious it'll become, in my view. It's not the kind of regulation we ought to be doing.
Jim, can I say something on that? I mean, I have an opinion about CEO pay, and I have the same human reaction that most people do when I see the numbers. You know, it's kind of staggering. But I'll go back, I'll echo something that I said at the podium, which was, you know, we need to figure out what caused this problem before we fix it. And someone saying limiting CEO pay implicitly is saying, I think that had something to do with it. And, you know, I can't see any evidence of that. People have started to look at that carefully, and I mean, if the evidence is there, and maybe there is evidence, but we haven't found it yet. Fixing it, it's not going to fix this problem. Maybe it'll fix some other problem, but it's not going to prevent what we just went through. That didn't happen because those guys were overpaid.
Can I just add a point? I hear what you guys are saying, and then you have to ask, so why'd Congress do this? And there is an extraordinary gulf between, you know, a learned academic view on this type of issue and political reality. Political reality is that members of Congress stand for re-election every 2 years. They're being asked early in 2009 to vote for a $787 billion, quote, bailout to provide the equivalent to subsidy for people who created a mess, which, among other things, has hurt their 401ks, threatens their jobs, frozen the ability of the economy to expand, led to unemployment either at a nominal rate of 10% or, if you want to take underemployed, 17%. And they're furious. And the impulse of Congress, which is not necessarily commendable, is often to punish people, often to respond in a way that's more bludgeon than scalpel. And you saw some of that on this. The practical reality for many in Congress is they can't support things like a TARP program or a stimulus package unless they also address executive compensation. Now, does that mean what you're saying is wrong? No, but it does, I think, characterize that those of us at the University of Rochester and many academic institutions are living in a different world than the front line in this political process.
Well, taking my prerogative as moderator, I might add that certainly there's the political reality of what you say, and a lot of people are furious, and there's a lot of political pressure. But just to give one fact, take AIG, for example. The top 75 people that were examined by the pay czar and who had their pay limited, over half of those people have now left and have gone to work for less regulated or foreign companies. So then the question is, from an economic standpoint, which is, I guess, where Cliff is coming from, is this a good thing or a bad thing? And one might argue it's bad, but then we understand I think, the political pressures that.
One of my favorite. I'm no historian. The historian in my family is my wife, but one of my favorite stories is the one about Xerxes. And after he got soundly defeated trying to invade Greece, because he ran his troops down what turned out to be too narrow a beach, and they got pummeled by the surf. He sent legions of men down to the sea with whips to whip the surf. That may have been a political reality, but damned if I can believe that was an effective policy or a reasonable use of manpower. And I just, when somebody asked me, is this an appropriate response? To me, it's like whipping the surf. If it's gonna accomplish nothing good, I'm going to have a hard time, in good conscience, standing up and saying, "Well, this is a god-awful idea, but the political realities are such that I ought to swallow hard and endorse it." I ain't going there.
Okay. I think we're beginning to run out of time, so I think I'll ask a question here, and then perhaps we can have some discussion afterwards if people are interested. There's a couple of questions here on consumer finance and mortgages, so I thought I would ask one of them. Tony, I think this is directed to you. It says, if you suggest that the government should not get rid of subprime and it should be available to some, then wouldn't it cause the same problem where people will try to get approved for it? Do you think changing the compensation style of the loan officers will solve this problem?
Do I think? I don't think that would have any effect at all. If we change the compensation schemes of the loan officers, we'll just get different people doing the loans, and they may in fact do the same thing. I think that the reason why we had this mortgage meltdown is because the price of the mortgages was wrong. If everybody defaults on their mortgage at once, then that hurts everybody, and that was not built into the price. And so what we need to do is to figure out how to get the price right. And that's why I thought that thinking about rating mortgage-backed securities and trying to design policies to fix that part of the problem would be way more effective.
Okay, so before we break here, would like to just have some closing remarks that relate to especially those of you in the business community here in terms of thinking about ways that Simon can help you and your organizations going forward. Just want to mention some of our programs and things that you might be interested in. One is, of course, continuing education for existing employees, our executive MBA program, our part-time MBA program. We also have specialized master's programs in finance, accounting, marketing, general management, and medical management. And there are various non-degreed offerings, seminars on special topics that come up from time to time that you might be interested in. Another thing that we have is a prominent network of alumni and friends numbering nearly 12,000 that might provide useful customer and supplier leads. These, just to name a few, include people like the CEO of Goodyear, the co-founder of MySpace, the CFO of the New York Times, the head of strategy at Eli Lilly, brand managers at P&G, Kraft, Unilever, Conagra, and various key executives at top commercial and investment banks around the world. Another thing that the Simon School might have to offer are faculty consultants as well as MBA student teams that have been useful in the past and will be in the future for helping management solve real-world management problems. Of course, I can attest, having taught in our MBA program for a long time, we have many fine students who are looking for internships as well as full-time job opportunities. One interesting thing is that surveys tell us that up to 75% of current MBA students would consider and would like to stay if the opportunity arose in the Rochester area. So there's a lot of talent here that we hate to see leave our area. Finally, I'd like to encourage alumni and friends of Simon to keep the George Eastman Circle in mind. Currently, we have 215 members who provide roughly $1.1 million in operating support for Simon, which help us to fund events like the one we're hosting today. So with that, I'd like to thank the panel for enlightening us on this topic, and I'd like you to give a round of applause here. Thank you for coming. It's nice to see such a good turnout. As I said, some of us will be hanging out around for a while afterwards, but that's the end of the formal presentation. Thank you.